By the way, this webinar is sponsored by the Vantage Point intermarket analysis software based on two patent-pending technologies. Vantage Point forecasts market trends and trend changes with up to 86% accuracy. If you trade futures, forex, stocks, or ETFs, Vantage Point will help you become a more profitable trader. This session, you should be able to see my window open. This session we have done it for two sessions, two webinars last week, and also this week in a Spanish room. And the idea was initially to backtest a series of technical patterns, specifically candlestick reversal patterns, a swing failure in the RSI, which you can see here on the bottom window, and support and resistance analysis. I started asking the audience in the Spanish room which pair they would like to see the backtest performing, and the pair chosen was the euro dollar. So we started backtesting on this pair. Here are the trades that we already did in the paper trading mode. And the idea was initially not to teach a strategy in itself, but to show you how we deal with confluences of technical arguments. In this case, we have three arguments that we would use to enter a trade, which is again support and resistance analysis, basically horizontal ranges, horizontal lines, a few of the most basic reversal patterns using candlesticks, up to 3 candle pattern formation, and a very specific signal which can be derived from the RSI, which is a swing failure. Okay. Is anyone not familiarized with a swing failure? Yes, we would not enter too much into the pattern itself, but to the combination of patterns into a trading sequence, so to say. So everyone in the room knows what a swing failure is in the RSI. Okay. If not, just raise your hand and I will show you an image. Initially, what we wanted to show is the fact that besides of the confluence of technical arguments, our approach when backtesting is and when accumulating statistical evidence is to go the other way around. That is, if I have an idea of a specific setup that I want to verify through a series of backtesting, I will then formulate an hypothesis which is easier to prove as true or false. And in that case, I'm interested to prove that the combination of these 3 technical arguments is not useful in order to accumulate profits. Okay, this may sound illogical or even a bit eccentric, but the idea is that if the backtesting at the end, or as we perform like we are performing now, shows evidence that this initial hypothesis may be wrong, may be false, then the alternative hypothesis, which is the fact that the combination of these patterns is useful as a strategy, may gain some attention for further testing. Okay, and this is it's not only a part of statistical thinking, but also quite healthy when you perform a back test, in order not to cheat yourself in trying to bend the rules in order to achieve a good result. Okay, so when we backtest, we try to prove that the strategy or the system is not going to work. Okay, and if it finally works out, then well, we have a first evidence that our hypothesis was wrong. Okay. There is someone asking for the. Okay, let me show you briefly. Switch off the cam. 1 second, I'll show you what the swing failure is. Okay, this is the swing failure signal as we see here, idealized. This would be the overbought and oversold bands in the RSI. It can be used in other oscillator type of indicators, but it's on the RSI where it is mostly used. As you can see, is like a W or M-shaped form in the indicator series, with a confirmation line or a signal line being broken by the fourth leg. Upwards is a buy signal, and downwards a sell signal. It belongs to the same family as divergences. It may have a divergence, a situation where we have a swing failure in the RSI, but it's not needed. You don't need to see lower highs, for instance, or higher highs here in the price series, and lower highs in the RSI to have a swing failure. Okay, you can have the same pattern printed in the price. Okay, a lower highs. The difference to the divergence is the fact that the swing failure has a signal attached to it, whereas the divergence is a first alarm, or that price may be turning around, but there is no signal. You have to use other tools in order to trigger your position. In that case, the swing failure has already a signal attached to it. Okay, is it clear? For the candlestick patterns, let me show you briefly what we are going to use. This is just a compendium of some of the most basic or most used candlestick patterns. We may use one or two more than the list here, just to draw your attention that there is the idealized pattern, or the generalized pattern as used in other markets, and we may adapt these patterns to the forex market. Okay, so there are slightly differences between the ones and the others. Usually in non-forex markets, we have a series of gaps between the candlesticks. Like here in the morning star, usually the star middle candle is usually alone or separated. The bodies are separated through a gap from the first and second candle and third candle, whereas in the forex you have there is no gap. Okay, so little differences. These images are taken from the learning center, so I've just shown here as a means of an example. All right, so we come back to our window, where you see there are already several trades performed, and you can see the rectangular shapes which are used to identify those support and resistance areas. And what I will do now is I will just move forward in the chart, and we will try to identify tradable patterns. Okay. Well, we are not going into specifics, Eklaya, as for the identification of patterns. In the case we find a pattern, we may discuss it, but we will not go into specifics. Okay, we will apply the strategy. My idea is that you see how a backtest is performed with a combination of three technical arguments. Okay, so I have this level here down here, which I will not extend. Will not extend it to the right. I already have. You see this movement here where it stopped here. It broke through and it tested it as support. So for me, the gain here, or the role this area played is already finished. For a short commitment, it was in fact this area here interesting, where we entered a short trade and where it stopped out here. And now I'm waiting either to see a comeback eventually to this level here. We see a small base building and acceleration from a level that initially was the start of an up move. So we'll see if we have some reaction to it in combination with a specific pattern. In the RSI, we see the RSI is not printing a swing failure. The second low is lower than the first, so we keep moving. Okay, I'll zoom the chart. I may want to see what it happens with diagonal lines, or how prices react to it. Okay, we have here a breach of that line. For now, no pattern in the RSI. I must also mention the fact that the RSI is comprised of 9 periods. Okay, slightly slower than the 14-day or 14 period as suggested by Wallace-Weiler. It's the designer of the RSI. You may ask why 9 periods. The fact is that what I want to read through the RSI, the information I want to extract from the price series, are very short-term patterns. For this matter, I only need a very small cycle in the RSI. Okay. The duration of the candlestick patterns will be maximum 3-4 candlesticks, and the entire move may entail 6 to 9 candles, and that is the period I've chosen to have the RSI calculated. Okay, I'm aware that by reducing the periods to be calculated in an oscillator, I'm making it more nervous and more prone to stay overbought and oversold. But that is not a problem, because I'm using it for a very specific pattern only. Okay. Oh, we have here a nice engulfing pattern. Okay. We also have the rejection of a diagonal resistance now turned into support line. I could choose to enter this position if I see a nice ratio. And you may decide, in such circumstances, we have here now 2 patterns out of 3 technical arguments that we may use to enter a trade. I may choose to enter a trade based only on 2 patterns. Okay, so we have here a support and resistance. In that case, a support level being rejected, and we have also a bullish engulfing candle. Okay, so I may ask you if you would enter here a trade, and if you decide so, you can enter a trade and see how it develops. So you decide. Seems like we better wait. Okay. So I just keep moving. And I would need now to identify those areas where I would like to see a reversal, right? And in that case, I might choose the next level above this one, which is already consumed. I see there was an initial V top. In that case, it's an inverted V, but it's called a V top, and I saw the reaction here. And the next interesting level for me would be this one. Okay, this area here. Okay, this is for the upside. As for the downside, if we keep moving up this area, this new established support might be interesting to see in the future. Okay, so we move on. There may be some reaction to this level here. We saw the spike. That spike here shows that price was picking buy orders from a lower level in order to reach a higher level, and again it was picking the same orders again on the same level. On the RSI, we have no pattern for now. We have a cross of the 50% level, which we would like to decide to use for a new commitment, but we need at least two arguments. So I'm looking both to price and to the oscillator series, and here I see how price enters the area which I initially draw here. Okay, so we pierced into that area. Okay, we see initially. Let us verify what happened here. We see how prices left this area with not too much strength, but as soon as it's reversed to pick the supply in that level, we saw how it rejected it. So we will keep an eye now as what happens to price at that level if we have a reversal pattern. You see how the RSI stays for quite a long time above the 70% level, and here we have now a reversal candlestick pattern, which is bearish engulfing. Okay, the second candle's body is engulfing the first one, which is a white candle. Okay, it's happening around the level that we expected it, but we would need another argument to enter the trade. Okay, at least a signal here from the RSI in the form of a swing failure, which there isn't, or a move lower from this resistance area. Let's see what happens. Okay, and we see another pattern. In that case, we can consider it a valid pattern, valid bearish engulfing. It happens on the resistance area, but we may pay attention that when identifying reversal patterns, that the previous move is against the signal that is printing the pattern. Okay, So we may find combinations of candlesticks which from derive from the form and from its dimensions of volatility may meet the criteria of a candlestick pattern, but if there is no previous trend, there is nothing to reverse. There is nothing to reverse. Okay. I may use here the breach of the 50 line. Okay, together with these two candlestick patterns, and eventually, since this is not a mechanical approach, but more a simulation of a discretionary approach with a combination of three arguments, I may use this head and shoulders shaped line in the RSI together with the signal, which is the breach of the 50 line, together with this with a candlestick. I may place an order also for you to see some action here. We'll place the stop above the whole event. Okay. And my take profit will place it around this level, which acted as support here twice. Okay. So the trade opens. We already see a move down. Okay. A reaction here with this small hammer-shaped candle. Sorry, I will make it bigger. Okay, see this hammer-shaped candle. This candle is picking the orders that were left here when the price surged to the upside fast in this candle. So it's a normal reaction here. We are still in positive territory. Okay, now some indecision in this spinning top-like candle. Okay, so there is not a lot of impetus, and I may think here to move my stop to closer to my entry. I may take the second event here, the second pattern, to protect my stop, and let's see how it moves. We see the RSI flirting here with the 50 level, so we may decide here if we want to keep that trade open or close it for a very small profit right now. You may decide if you want to participate. There is no real trading. This is simply paper trade. You may decide. Is there any commitment? Would you like to move the stop a little bit further? Would you close out the trade, or let it like it is? Okay, fine. Thanks, Fabian. So, that was the right choice, it seems. Okay, now, okay, we have here now this could be interpreted as a piercing pattern, a two candlestick pattern, right? Reacting to the demand that was seen in these three white candles. Okay. The lower shadows are still quite small, and the relative shape or size of the candles is still not above average if we consider the length of the previous candles, especially the black candles that we use to enter the trade. That third black candle here, which which showed us that our direction was the correct one. These shapes, their volatility is bigger than this pattern. So what I may do here is just as a measure of caution, just move my stop to break even and see how it performs. Okay, now we see that our target was hit, and we were right in identifying this bottom here as a demand level because of these three candlesticks here going up very fast. Also this small engulfing, bullish engulfing here, and we see that that we were right in that positioning. Okay, let us see what the RSI is doing, and we missed now for one candle. We missed probably this swing failure type of pattern here, where the signal would have been the last candle in the previous, not the current one or the current closed one, but the previous one, which belongs to the candlestick pattern. So we may choose to enter now long, okay, and protect our stop, protect our position with a stop below the level where we took profits. So new order, we place the stop here below. If I take profits, in that case, I would leave it open, because if it breaks through this level, then I expect to take profits higher than this. Okay, and I would need to go further back in price in time in order to spot for a take profit level. Probably we can go as high as this high here on the chart. Okay, fine. Okay, we enter our position. Position is entered. We see it gapped higher. Probably it was a weekend, a Monday open or Sunday open. This reaction here, now we see, in fact the platform is showing us it's a Monday. We see that reaction is a typical Friday afternoons reversal, which is quite frequent in the second half of the day, by end of the week, where profits are taken, and this gap is already filled. We see the smaller, the lower candlestick shadow here is already filled the gap, and is a white candle. So we may feel confident that the position will move favorably. It's now reacting probably to the top of this previous candle, and here we have again a reversal pattern. In that case, this would be interpreted as an evening star. In forex, evening stars have this shape as we see it here. Okay. In other markets, you may need to see this candle above the previous one. Okay. And we may choose to liquidate our positions at a loss because of this strong reversal pattern reacting to this resistance level. Okay, so I would choose to close the position here for a small loss, or eventually we can also move our stop and reduce our risk by placing eventually the stop here below the closed gap window. Is there anyone who has a preference as for reducing stop, stay in the position, or liquidate it, or liquidate the half of the position? Okay, we entered it with 2,000 units. We may reduce the half, for instance. If there is no preference, then I would liquidate for a reason. In order to enter a trade, we are searching for confluence of technical arguments. The more technical arguments, the stronger the commitment, the setup is, but also the more conservative, because if we choose to sum up 3 or 4 technical arguments, the more we need in order to take a decision, to make a decision to enter a trade, and the more opportunities we will lose, right? Because we need to see more arguments together. And as for exits, it's always better to use just one argument to exit the position, not to wait for to gather enough evidence. Okay, this is usually done. Right. Okay, Fabian. So we just close our order, and you are spot right. There was a spike on the, and here we see again a reaction to the upside, a nice bullish engulfing. We don't see any pattern in the RSI, so let's see what price does in relation to the price range where it is trapped right now. Seems like to be in a corrective mode, and looking also closely to the RSI. Now we're touching the level which we have seen in the historical price, which is this high level here. Let me see. We still have higher levels than this one that we may choose to use, but for now let us stay with that one. Sorry for moving so much the chart. Okay, here we are. Sorry. And I open up the window, the RSI window, and let's see how it reacts to that level. Okay, very small candles, not really a strong reaction, but you see even with small candles, the RSI dropped from overbought to oversold. That's simply because it's a very sensible indicator, generally speaking, but also here with a very short time period in the calculation. So we may see these violent moves from one overbought situation to an oversold, but it has absolute no meaning here, since we are not trading against the trend with an overbought or oversold type of signal. Still reacting to that level. Okay, let me pause here. Here we had a what could be a swing failure. Okay, we see there's the signal would have been the breach of this horizontal line. Okay, it's not necessary that the swing failure happens on overbought territory. It can happen also between the 50 level and the overbought band you choose to trade, 70 or 80. Okay, it may happen here. So we had in this case that event in the RSI triggered by a very small candle. So we didn't really took that very seriously. So let's move on. And here we have something interesting. We have again a swing failure. Okay, let me draw it on the charts. Okay, this is a signal. We see this V shape or a W shape. Okay, in that case, the first peak down was above or below the 30 level, but that is not a requirement. And as for the candlestick pattern, we see here a bullish engulfing. It is reacting to a level which already had its previous reaction. Okay, it went slightly below. Okay, I consider all these area here where we have this spike down to be an interesting area to buy. So in that case, I will enter a long trade, but I will reduce the position size to the half because my stop will be a bit further from the entry level. Okay, and I will leave for now the take profit open, and I will buy on that signal. Okay, we wonder if we have the stop placed. Let me see. Active trades. So RSI flirting here with a 50 level. Okay, no, seems okay. It is again reacting to this top here, to this level. We may choose to move our stop. I think we didn't enter our. Let me see if I can. I don't see the trade here in order to modify it. Okay, I will not lose more time with this, but we'll see what happens here. And since it's not performing higher and reacting to this level, I'll be very cautious here as to what prices do. And this candle here is showing a strong willingness to go to higher levels, picking demands at these lower levels here. So let's see once again how it reacts to these upper levels here. Well, this shadow here is not looking good. Okay, it's entering deeper into the resistance level, deeper than the previous top, the original one from this whole corrective mode here. But seems like we have no order really. I would like to close here, but seems like it's showing me that we have no order. Otherwise, I would close it here. Okay, seems like we entered and closed it very fast here. Must be some error in entering the trade, and we must account to these things. They also happen in real trading, so we'll let that result be. So okay, so since now we are breaking above that level. Okay, We also pay attention if you we want to ride this trend. We pay attention to this kind of patterns picking up demand at lower levels. This retracements along the trend. Obviously, if we want to see them together with an identifiable pattern. Okay, here we have you see a type of swing failure. Okay, together with a very bullish candle, which we may use, or we may interpret this action here as a correction within a trend. Okay, so we expect this area here to be the first big correction within the trend, and we would expect now to see some impulsive move to higher levels. Okay, so in that case I will put a new order with a stop below this event here and let the trade open, the take profits open, and see how it evolves. Okay, there's beginning of the week, a small gap which is already closed, and let's see how the rest of the week performs. We would need here to see, in fact, if this reaction is a reaction to any level before. We may head in, and we see there is a huge move down here. Now it's just seen as a line on the chart. Okay, but we feel confident that the price is trying to pick the supply here at that level. So we will frame that area. Okay, here a small retracement within our trends. Again, these reactions with a higher shadows here, entering and piercing into that area. So we see there is a reaction despite the long time that has passed since price was at that level. It was in December 2010, and right now we are already in April this year. Okay, so and still there is some reaction. Still have a few minutes to go. Okay, here we have now a pattern which already doesn't look very good to forward trade. Okay, still in a what seems to be a corrective market here, reacting to that level. This reaction now stronger than the previous ones. Okay. We still have room for our stop, so we may decide to keep in the position. Oh, Fabian is asking, what about April 4, 6? Isn't there also swing failure? Let me check. Well, I'll make the site bigger. 4, 6. You made this one. You may be probably this shape here. Well, we could be flexible and take it as a swing failure, but thinking that we have a very sensible RSI, which is very sensible to also to small candles, and I would prefer to see a more W or M shaped. Okay, we could eventually take it, but if we observe here the shape in the price series, we do not see a movement here down that makes us think of a testing of this previous low, like it would have been with a lower shadow here in this white candle. In that case, we would probably have a lower shadow, but a lower entry. Okay, because the RSI is not accounting for highs and lows. It just takes the close prices. Okay, this is also important. Different to other oscillators, for instance, the stochastic does in the percentage K line does have implicit the high and low levels, but not the RSI. These are only close levels, so I would like to have close levels building more a shape like an M or like a W. It's not so much the size of it, but the size relative to both peaks. Okay, for instance, here we could eventually take this one as a swing failure. Okay, but this is a preference. As far as I know, there is no rule to it. There may be guidelines, but not a strict rule, as far as I know. So I would always look to the sensibility of your oscillator, the oscillator you are using to draw the lines. Okay, and also think that if that oscillator takes only close prices or also high and low, because that also makes in that case the RSI, as I said, doesn't take into account the shadows. Okay, only bodies or only close price, because the close price is part of the body, not of the shadow. Okay, seems like we are only few minutes left. Let's have a look here to not that one. I wanted the other window. Sorry. Oops. To the history. This is the order history. Okay. Here we can see more or less the results. Some of the results were the ones that we took in this webinar. Other results are from the previous two webinars we did in the Spanish room. Okay, we will see in a minute the more calculated statistics. Let's just finish with this position. So we still have room here. So let's see what happens to that one. Definitely is not wanting to reach that level, but the supply coming from this level is already weakened in these last candles. We have this big shadow here, picking up demand from as seen in this previous line here. I would not call this a piercing line because it's emerging in a lateral market, and for a piercing line to be valid, one of its criteria is that it appears after a downtrend, which is not the case. And here I would be already very cautious and already stopped out. Okay, so let it be the last trade. We will close the. I think we can get a report by clicking here. Let me show you the report by opening the other window. And here we have. So this is the equity line, the number of trades. Obviously, very few trades in order to draw a conclusion, but already we are having some idea that the combination of these three technical arguments may lead to a successful trading strategy. Okay. In that case, our initial hypothesis, which is the negation of that strategy, would start to appear like false, which is in fact a good signal, because what I like is to see my alternative hypothesis, which is the one that says that the combination of these patterns can lead to a successful trading strategy, may gain some evidence. Okay. Further testings would be needed, more trades, other markets, and finally also in case the results are positive, we would also like to screen out which patterns were maybe more profitable. Since we have several candlestick patterns, we like to choose the ones that were more profitable. But for that, we need obviously a huge amount of trades. Okay, and here we see the average win trade superior to the average loss, which is it's a good ratio, a good control of risk, like through moving stops, protecting the trade. Okay, liquidating trades in case of any doubt, of any event or technical argument against our initial position. Okay, the accumulated pips seems like in short trades were better than long trades, but all this data is we can't draw a conclusion because of the very low number of trades. But we see like with a quite modest average win trades, win rate, that we can have a nice equity curve. Okay, so we don't need to reach a 70-80% win range to accumulate profits. This is far from the truth. What we need, in fact, is to control risk, to manage the trades, and you can be very successful trading around the 50% win rate. Okay. There's a trade by trade advance. By the way, this is the platform I'm using. It's called Trade Interceptor. It has this paper trading mode, which is quite useful, especially if you are using candlesticks, because it prints the whole candle, the closed candle. It's different from other platforms which are specific for backtesting, where you see the candle advancing tick by tick. Here we don't need it, in fact, because candlestick patterns are only identified when the candle is closed, so we can work with closed candles perfectly. And hope we learned something new, and if you like, we can perform a different strategy or the same one next time. I'll be off on holiday for the next 2 weeks, and we'll be back in beginning of September. Enjoy the summer. And Mike is also asking, do you consider fundamentals or news and data releases? Well, don't know if you are asking specifically on this backtesting. When backtesting, I prefer to use only a price itself. Okay, and personally, I don't have the knowledge to trade based on fundamentals. Okay, I may be watching for if there are obviously economic releases, but as a technician, I don't have the enough knowledge to drive a conclusion to base my trades on fundamentals. I hope that answers your question. Okay, thank you very much for your kind attention, for your participation, and see you soon again. Thank you. Bye bye.